Hi, I'm Justin Miller with the Chong Miller Group, and I'd like to welcome you to the Ask the Professor series of videos, and in particular to a three-part, if you will, mini-series on inflation, interest rates, and the housing market. In this mini-series, I introduce these three concepts as theoretical and show how they are actually determined and co-deterministic in the housing market, how they interact with each of the individual features of the marketplace. I ask that you watch these three mini-series parts in order because they'll be most meaningful to you in that way. As I was producing this video, I was thinking one longer video, but it simply became a little bit unwieldy, and I decided to cut it into three parts. So please hit the subscribe button, smash the like button, sit back, and learn part one, inflation. Hi, I'm Justin Miller with the Chong Miller Group. The Chong Miller Group is a Las Vegas-based real estate organization. We help people buy and sell homes. As regular viewers of my channel know, every month I provide two market update videos. One for the residential resale single-family housing market here in Las Vegas, and another video for the condo and townhome segments of the multifamily market here in Las Vegas. And in those videos, I provide you with current statistics, looking at where we've just been in the market and where we seem to be headed over the next 1 or 2 months. But I also want to provide greater context sometimes, things that are not in the current statistics, that look beyond those statistics to try to understand what's happening in the market. And so I produced the Ask the Professor video series to shed light on some of those deeper issues, some of those things that are actually driving the market forward or restraining the market, some of those things that give us a level of ability to look further into the future. And so that's what we're going to do here. So I've recorded this video in Q2 of 2022, and that means that the data that I'm looking at are coming from that particular point of time. But the information here is generally applicable across the market because of the way in which I look at these sort of background issues. So let me just take a minute to introduce myself for those of you who don't know me. Prior to becoming a real estate agent here in Las Vegas, I was a business school professor for about 10 years. I did my PhD work at NYU, at the Stern School of Business, and I taught at Ohio State University's Fisher College of Business and University of Southern California's Marshall School of Business. And so I want to bring to you my training, my theoretical training, because it's oftentimes very relevant to understanding what's going on in the real estate market and with what probably amounts to the biggest investment, financial investment that you'll ever make in your lives. So my academic training was in business, in organizational management more specifically, and the theoretical bases or disciplines in which that training occurred were sociology and economics. I also have some level of training and bring into the analyses sometimes social psychology and finance, and a significant background in statistical work. So with those educational predicates, I look at the broader issues that impact the housing market. And in this particular edition of Ask the Professor, I'm going to be looking at three interrelated issues: inflation, interest rates, and housing prices. And then I'm going to tie those three issues together by looking at affordability. Now, these issues are of long duration interest. So whether you're watching this video shortly after I release it, or you're watching this video years later, the issues are the same. inflation, interest rates, housing prices, and impact on affordability. They're consequential, and they give us a deeper understanding of what may be going on at any particular time in the housing market. So let's go ahead and start. Let's start with inflation. Now, at this time, there are a lot of people complaining about inflation. There's lots of inflation in the environment. What does that really mean? Well, let's start with the definition of inflation. And you can go and search online and you can find multiple different definitions, but they're all approximately the same. And so in the most simplistic terms, inflation is a generalized increase in the price of consumption. Now, we could have negative inflation or deflation. That would be a generalized decrease in the price of consumption. Sometimes we hear the term disinflation, which is a decreasing level of inflation. So prices are still going up, but they're going up at a lower rate. Right? Nonetheless, inflation, generalized increase in the prices of consumption. Now, those are three important issues to keep in mind. One, if prices are stable, they're not increasing, then we're not seeing inflation. So that's pretty easy to understand. Two, the increase in prices have to be generalized. They have to be generalized across issues of consumption. So if we simply saw that the price of eggs suddenly tripled, but other prices remained flat, we'd not be talking about inflation. We'd simply be talking about some problem in the egg market that was causing aberrant pricing in eggs. Okay, but that's not inflation, because it's not generalized. Now, the other thing is consumption, generalized increase in the cost of or prices of consumption. Only certain things count in inflation gauges, measures of inflation. Those things that are counted are consumption issues. Now, they could be products or they could be services. So let's think about what that really means. A service that could increase in price that would be an element of inflation would be the cost of travel, right? So if you're going to be traveling, you're buying a service. Perhaps it's a flight on an airplane or a ride on a train. Perhaps it's staying in a hotel. Those travel-related services, those count in a gauge of inflation. Law services, medical services, and so actually healthcare costs count in gauges of inflation. Now, there are products that count in gauges of inflation as well. So medicine, if medicine goes up in price, beyond the cost of staying in a hospital or seeing a doctor, medicine is a part of the inflation gauges. The biggest parts of inflation gauges are actually fuel, food, and housing. And then, of course, there are other parts that count, such as clothing, and transportation and medical care. And we certainly recognize right now, as I'm recording this, that the price of gasoline has definitely been going up. And so that's an inflationary pressure. It's measured in gauges of inflation. And because we've got generalized prices going up, certainly fuel prices going up are contributing to that considerably. We've had gas prices go up over the past, let's say, 1 year, from maybe $3.30 a gallon to $5.30 a gallon. That's really significant. Every time you put a gallon of gas into your car or your SUV, your truck, whatever, you're spending an extra $2. And most people don't put just 1 gallon of fuel into their car. They fill up the tank. And so maybe it's 15 gallons. So maybe it's $30 more every time you fill the fuel tank. Well, that's a lot of money that's coming out of your pocket. And that's what happens is when inflation increases, money's coming out of your pocket, you're spending more to consume the same that you had consumed in the past. the cost of consumption has generally increased. All right. Now, because it's a measure of the price of consumption, or the rate of increase or decrease in the price of consumption, there are certain things that are excluded from measures of inflation, gauges of inflation. And the things that are excluded are what we might refer to as asset classes, things into which you may invest. And by invest, I don't mean gamble. So I'm not talking about Bitcoins. I'm not talking about going to the racetrack and betting on a horse. I'm not talking about going and putting money into a slot machine. So if the slot you used to play on was $1 and now it's $2, that's not inflation. But it's also not an investment. It may be something in entertainment, and entertainment is a part of consumption, but just pure gambling is not consumption. Okay, so what kinds of things are asset classes? Precious metals, classic asset class, so gold and silver, etc. For precious metals. Gemstones, of course, might fit into that as well. You're not consuming them. They don't disappear when you wear a gemstone on a ring that you're wearing. The stocks that you may buy, or the indices for the mutual funds that you may buy. Currencies are actually an asset class. Land is an asset class. And in fact, housing is an asset class. So that means the price of housing going up does not mean, or in fact is excluded from gauges of inflation. But I had already said housing is included in inflation. So let me clarify that for you, because this is one of the issues where some confusion starts to arise around inflation. Housing is included in inflation gauges, but only as an issue of consumption. And so rent is an issue in inflation gauges. So as rents go up, that means inflation's going up. There's no question about that. Rent is consumption. Now, that doesn't perhaps adequately capture the full cost of housing consumption. And so housing consumption is also what's called owner's equivalent rent, which is a survey-based issue where the government goes around asking owners of property, small numbers of owners of property get asked this question monthly. What would be the equivalent that you would charge somebody to rent your property? Not if you were, being asked to move out of your house, but if your house were vacant, what would you charge to rent your house? That owner equivalent of rent, surveyed data, along with actual rent, is included as housing consumption, and therefore it's included in inflation gauges. At the beginning of May of 2022, the median capital value of a single-family resale residential property in the Las Vegas Valley was $475,000. And that was up 3.2% from the prior month, from $460,000. But that capital appreciation, 3.2% gain in 1 month, that's not consumption. That's not rent. It's not owner's equivalent of rent. That's the capital asset price increase on the investment that you've got. And so that's not part of the inflation gauge. So something kind of interesting here means that we could potentially, we're not at the moment, but we could potentially be in an environment where owners of property, single family homes, are making a lot of money as the value of their homes go up. But rent stays stable and we're not seeing any kind of price change in the rents, and therefore housing is non-inflationary. Now, it could be the other way. Rents could go up considerably while housing prices remain stable. And so we'd see inflationary pressures in housing, even though we're not seeing capital appreciation in housing. Often there's a level of correlation, but it's by no means one-to-one. And there's generally a considerable lag in the way rents respond to issues in the marketplace, such as supply and demand, and the way that prices, capital prices on houses, respond to supply and demand issues in the market. So that's what inflation is. It's a generalized increase in the price of consumption. And consequently, it excludes non-generalized price increases, and it excludes non-consumption issues. Now, what causes inflation? And this is a really important question. According to neoclassical microeconomic theory, of which you've all seen at some point in time in your lives, a supply and demand curve, the supply and demand curve intersect at a particular point, which is an equilibrium level of price and an equilibrium level of consumption. And the demand curve is downwardly sloping in price. So in other words, as price goes higher, the amount of consumption, or the amount of the quantity of demand, decreases, comes back closer to the axis. And so the demand curve is downward sloping in price. In other words, the lower price goes, the further out on the demand curve will go. If I'm thinking about buying something, let's make it some consumption issue. If I'm thinking about buying, I don't know, let's say French macaroons, and the price of a macaroon is $1. Maybe I'll buy one, maybe I'll buy two. Probably not going to buy a whole lot of French macaroons at $1 each. But if the price was 10 cents, I don't know, maybe I'd get a dozen, take them home and eat them over a day or 2 days. If the price were $2, maybe I'd still get one. If the price were $10, I'm not going to buy a French macaroon. Maybe I'll get a chocolate chip cookie. Or maybe I won't have anything in the dessert category to eat on that particular day, right? So as price increases, my consumption would go down. But supply slopes the other way. If I made French macaroons, if I was a baker and I made French macaroons, if I could sell a macaroon for $1, it probably covers my cost. I'd probably be happy, and I'll just sell macaroons for $1 according to however many the people want. But what if I could sell a macaroon for only 10 cents? I might not be willing to sell any. It might not actually even cover my cost of production, let alone my cost of marketing and my cost of sales. So my supply, my willingness to supply into the marketplace at 10 cents on a macaroon may be highly constrained. On the other hand, if I could sell macaroons at $10 each, I might even open a factory and hire multiple more people to help me make as many macaroons as I could, because I don't know how much it costs to make a macaroon. It's probably something on the order of 25, 30 cents. Totally making that up. I don't know. It's a pure guess. But if I could sell something that cost me 30 cents, let's say it cost me actually 50 cents, and I could sell it for $10, I'd want to sell more than I could sell right now. I'd want to produce more. I'd want to grow my business to sell as many as possible. So in other words, as price goes up, suppliers come into the market and they produce more. Maybe new suppliers even come into the market and they produce more. Now, an interesting thing happens in neoclassical economic theory. And that is that if we move out of equilibrium, price goes, let's say, too high. What that's going to do, it's going to cause consumption to fall back, but it's also going to cause suppliers to want to increase their level of production because the price is hot. And those two things cause the economy in this market, the economy for French macaroons, to fall back down, because now we've got more supply and we've got less demand. And so that's going to cause pricing to come back down to the equilibrium point where we end up clearing the market at a certain level of production, sales ability, product in the market, and a certain level of consumption. Now, that's an interesting feature in neoclassical economics. It relates supply issues to demand issues and suggests to us that an economy will seek an equilibrium level of pricing and consumption. So how then does neoclassical economics tell us anything about inflation, which is a generalized increase in the price of consumption? Well, it doesn't shed specific light for a couple of reasons. One is neoclassical microeconomic theory is microeconomics, meaning it's actually at the analytical level of the individual consumer, not at the analytical level of the macroeconomy, the larger economy in which we exist, which is the economy in which inflation or deflation actually occurs. Although we experience inflation as individuals, it's something that's occurring in a generalized manner, so across the macroeconomy. But it does suggest something about the partially self-correcting nature of inflation, which is kind of interesting. And that is that as prices go up because of inflation, consumers are going to pull back and demand less, which is going to cause an excess level of supply, which is going to push prices back down. In fact, as prices go higher, suppliers are going to step in to produce more because they're able to sell their product for more, and they want to sell more product at higher prices. And that's going to cause an increase in the level of supply, which is going to cause prices to go back down because supply is not being demanded sufficiently. And so, in other words, the neoclassical model here shows that inflation is at least partially self-correcting. As prices go up, we get more supply into the market, we get less demand in the market, which causes prices to go back down. The problem is, supply and demand are not necessarily fully self-correcting, and neoclassical microeconomics is an analysis that takes place at equilibrium. And when we move away from equilibrium, there's nothing in the theory that tells us how long it's going to actually take to self-correct. So it may take 3 years for new suppliers to enter into the market just because of regulatory issues or capital investment issues to build their factories. Or training issues to hire and train bakers to make high quality French macaroons, nor does it say how long it's going to take buyers to adjust their behavior. It may take them quite a while to wean themselves off French macaroons to reduce demand. The theory is silent on that issue. So there are other economic theories that can help us to perhaps accommodate some of the issues that we deal with in inflation. There's one more point that I want to make about inflation. And I want to make this point because this is something that comes up in a lot of news coverage, certainly a lot of the political discourse. Now, this channel is absolutely not about politics. It's about the real estate market. The issues that I cover here are those that influence what's going on in the real estate market. But in order to understand what's going on with these factors that influence the market, we have to understand the factors themselves and the things that are influencing those factors. And so in discussions of inflation, as I pointed out, generalized rise in the price of consumption, the issues that influence inflation are demand related and supply related. So in the discourse that's taking place in the background right now, there's a lot of conversation about how the particular presidential administration has caused significant increases in prices. And frankly, it doesn't matter who the president is at any given point in time. Presidents don't cause inflation. They also don't cure inflation. That's not something within the job description. It's not something within the powers of a presidential administration. There are two ways in which the government may influence the overall economy. One is monetary policy through the Fed, which we'll talk about with regard to interest rates. The other is fiscal policy, which is the spending and taxing of activity that takes place otherwise in the economy. And so a president doesn't get to set taxes and doesn't get to spend. Rather, Congress and the president have to mutually agree to increase or decrease spending and to increase or decrease taxes. So fiscal policy is not within the purview of any one branch of the US government. So that's kind of at a larger analytical level, but then let's look down a little bit tighter. Well, people have always wanted to blame presidents for increasing inflation as well as for increasing unemployment. Because it's easy to point to an individual person and say they're the cause. It's not something that's real. So fiscal policy, the spending of money and the taxing of other activity in the economy, not only set by the president and the Congress collectively, in mutual agreement, no setting of policy. In fact, everything stops, as we've seen over the past 20 years approximately in the US. The government occasionally shuts down. That's where Congress and the president don't agree. And so no budget gets passed. And so tax collections become deferred. Spending shuts off and or becomes deferred. So there has to be actual mutual agreement. But what about if Congress and the president decided, well, let's increase spending a whole lot? In the US, the federal government amounts to something approximating a quarter of the US economy. If the government decided to double its spending, which is incredibly unlikely, has never happened, except possibly during World War II. I don't know what the actual statistics are during World War II. That would create significant demand in the economy. Of course, during World War II, a lot of that was replacement demand because there were rations put in place and people couldn't just go out and buy things. So the government was buying up all of the steel and all of the gunpowder and all of the magnesium and all of the rubber that they could access in order to manufacture war goods. And so there was displacement from civilian economy to military economy for the purposes of gearing up for and fighting World War II. But that means that the government didn't really create a lot of inflation necessarily at that point in time either. So it would be very, very difficult to see something that the Congress and the president could agree on, regardless, again, of what the administration may be during a particular point in time and who controls Congress during a particular point in time, that they could agree to something that would have such magnitude that it's actually going to induce large levels of inflation. Fiscal policy is hard to maneuver at those great levels of scale. Now, we did just see the last administration in Congress, as well as the current administration in Congress, react very forcefully to shutdowns of the economy, where displacement was actually required, where it was important to substitute government spending for private spending that disappeared at a time that people were not earning income. So there may be changes that take place like that. but the government doesn't actually get to significantly influence inflation. So that's inflation, a generalized increase in the price of consumption. And as inflation goes higher, it becomes more expensive to engage in the level of consumption that one's used to engaging in, the consumption they'd engaged in yesterday, the day before, the year before, what have you. And that means either people need to find some other source of funds to support their level of consumption, or they need to reduce their level of consumption. And so inflation feels bad, right? It costs more to do what we used to do, or we can no longer do what we used to do. We've got to substitute, or we've got to cut down. I hope you found the inflation video, part 1 of inflation, interest rates, and the housing market, to be interesting and educational. Please watch parts 2 and 3. Part 2 is about interest rates, how they're determined, and what the impact of them is, and why interest rates are important with regard to both inflation and the housing market. You can hit the button in the lower right portion of this video to get directly to that, or you can go back to our homepage to get to the part 2, the interest rate video. Again, I hope you've enjoyed this. Please subscribe, smash the like button, and I look forward to seeing you in the next part of this 3-part miniseries.